The Supreme Court of the United States recently revealed something that every senior homeowner in this country needs to understand immediately. And the fact that most people have not heard about it clearly is costing retirees tens of thousands of dollars they never expected to owe. Here is the reality of where things stand right now. The IRS already has your home records. Not some of them, not a summary. The actual detailed records, your deed history, your mortgage data, your equity transactions, your rental income, your estate and inheritance filings, all of it sitting inside a federal database that is being actively cross-referenced against your filed tax returns right now using technology that did not exist just a few years ago. And the number that keeps showing up when seniors discover the gap between what they reported and what the IRS believes they owe is staggering. We are talking about assessments reaching $77,000 or more by the time back taxes, accumulated interest, and accuracy penalties are calculated together. That is not a worst-case scenario pulled from a rare extreme case. That is what happens in completely ordinary situations. A home that appreciated significantly, an inheritance that was never properly documented, an equity loan that was used for the wrong purpose and deducted anyway. Ordinary decisions made without complete information, now sitting in front of an enforcement system that is more powerful and more automated than anything the IRS has ever operated before. Today, I am going to walk you through exactly what the IRS has, why the Supreme Court's recent activity makes this more urgent than ever, and the 4 specific situations that are putting senior homeowners at the greatest financial risk right now, along with exactly what you need to do about it. Before I get into the specific situations, I need to give you the context that makes everything else make sense, because without understanding why this particular moment is different from every tax year you have navigated before, you will not fully appreciate what is at stake. The Supreme Court has been weighing in on fundamental questions about the IRS's authority and the legal boundaries of income taxation in ways that have sent significant ripple effects through the federal enforcement landscape. The court's recent rulings clarified and in meaningful ways validated the scope of congressional authority to define taxable events related to property, equity, and transferred wealth. That legal validation landed at exactly the same moment the IRS was completing a multi-year infrastructure rebuild funded by the $80 billion appropriated through the Inflation Reduction Act. What that combination created is an enforcement environment unlike anything that existed before 2024. The IRS now operates automated data matching systems that pull from county deed records, mortgage servicer reports, title company closing disclosures, short-term rental platforms, estate and probate court filings, and home equity lender data, and compare all of it simultaneously against every tax return associated with the property owners involved. The system does not make judgment calls. It makes mathematical comparisons, and when it finds a gap between what third-party sources reported and what you reported on your return, it generates a notice automatically. By the time that notice reaches your mailbox, the IRS is not asking whether there is a problem. They have already concluded there is one. What they are doing is telling you what they believe you owe. Senior homeowners are being flagged by this system at higher rates than any other demographic, not because seniors are dishonest, but because seniors are more likely to have the specific types of home-related financial histories that these systems are built to examine. Decades of appreciation, home equity transactions, inherited properties, deed transfers to family members. These are the exact situations sitting in the crosshairs of the IRS's current enforcement posture. The first situation involves selling a home that is appreciated significantly and miscalculating or completely missing the tax obligations on the gain that exceeds what the law allows you to exclude. Most seniors have heard of the home sale exclusion. Many know that married couples can exclude up to $500,000 of profit from a home sale tax-free under Section 121 of the tax code. What far fewer people understand are the specific ways that exclusion gets reduced, miscalculated, or lost entirely, and how the IRS's current data infrastructure is specifically designed to identify when the exclusion was claimed incorrectly. The exclusion requires meeting both an ownership test and a use test within the 5 years before the sale. You must have owned the home for at least 2 of those 5 years and lived in it as your primary residence for at least 2 of those 5 years. For married couples, both spouses must satisfy the use test for the full $500,000 exclusion to apply. And this is where many couples make a costly assumption. If one spouse moved into a care facility or lived elsewhere for an extended period, the use test may not be satisfied for both people, which means the exclusion could be limited to $250,000 rather than the full amount. On a home worth $600,000 that was purchased for $100,000, the difference between those two outcomes is enormous. What makes this a current enforcement issue rather than just a planning consideration is the IRS's ability to cross-reference your home sale reporting against county deed records, title company closing disclosures, and prior year's returns that establish your address history. If the numbers do not reconcile, if the gain on your return is smaller than the data suggests it should be, or if the exclusion you claimed is larger than the system calculates you were entitled to, the flag generates automatically. And a $77,000 assessment in this scenario is not an exaggeration. On a home with $600,000 or $700,000 in appreciation, a miscalculated exclusion combined with interest and accuracy penalties can reach that number and exceed it. The second situation is one of the most widespread compliance gaps affecting senior homeowners right now, and it involves home equity loans and home equity lines of credit used for purposes that do not qualify for the interest deduction that many people claimed anyway. Over the last several years, inflation drove up the cost of living significantly for people on fixed incomes. Medical expenses, prescription costs, everyday household expenses, all of it increased while retirement income stayed largely flat. Millions of seniors turned to their home equity as a financial lifeline. They borrowed against the wealth in their homes to cover real pressing needs. That decision was completely reasonable. The financial logic behind it was sound, but here is the compliance gap that is now generating automated flags across the country. Under the Tax Cuts and Jobs Act of 2017, which remains fully in effect, home equity loan interest is only deductible on your tax return if the loan proceeds were used to buy, build, or substantially improve the home that secures the loan. If the money went toward medical bills, debt consolidation, college tuition for a grandchild, or daily living expenses, purposes that are completely legitimate uses of your own money, the interest on that loan is not deductible. Not partially, not with limitations, simply not deductible under current law. And if your tax preparer claimed that interest as a deduction on Schedule A of your return, you now have an incorrect deduction on file that the IRS's lender data matching systems are actively identifying. The penalty structure that follows is what drives assessments toward that $77,000 range when combined with other issues. The IRS assesses the additional tax owed on the improperly deducted amount, then adds interest calculated from the original due date of the return, then adds a potential accuracy-related penalty of 20% of the total underpayment. For a senior who claimed this deduction across multiple tax years, which many people did because nobody clearly explained the restriction to them, those amounts compound into a number that can be genuinely devastating on a fixed income. The third situation is the one that generates the largest individual assessments and the most financial distress, specifically because it typically affects people who are dealing with the grief of losing a spouse or parent at the exact moment the compliance gap was created. When you inherit property, whether it is your deceased spouse's share of the family home, a vacation property from a parent, or any other real estate, the tax code provides one of its most valuable benefits in the form of a stepped-up basis. Your cost basis in the inherited property is reset to the fair market value at the date of death, not what the original owner paid years or decades earlier. For property that has appreciated significantly, this benefit can eliminate or dramatically reduce the capital gains tax you would otherwise owe when you sell. But the stepped-up basis only protects you if it is properly documented. If the estate did not obtain a qualified appraisal at or near the date of death, if no Form 706 was filed for estates that met the filing threshold, if no records were created establishing the fair market value at the time of inheritance, then you are holding property with an undocumented basis. And the IRS's current enforcement posture treats an undocumented basis as a zero basis until you prove otherwise. That means if you sell inherited property for $300,000 and you cannot document what your stepped-up basis should have been, the IRS can assess capital gains tax as if your entire sale price represents pure gain. At a 15% to 20% capital gains rate, plus the net investment income tax for higher earners, plus interest and penalties on the underpayment, you can reach $77,000 in tax liability on a property sale that should have generated little or no tax at all. The IRS is now actively identifying inherited properties by cross-referencing estate filings and probate court records against subsequent sale transactions. The matching system is looking for exactly this gap, a property that changed hands through an estate followed by a sale with no documented basis calculation connecting the two events. If that description applies to any property in your history, this is not a situation to monitor. It is a situation to address with a qualified tax professional immediately. The fourth situation catches more senior homeowners off guard than almost any other because it involves a decision made with the best of intentions, adding a family member to your home's deed. Millions of seniors have done this to simplify estate planning, to help a property avoid probate, to protect the home from Medicaid recovery concerns, or simply to make sure the people they love inherit their most valuable asset without difficulty. The motivation behind it could not be more understandable. But from a federal tax standpoint, adding someone to your deed is not a simple administrative change. It is a transfer of a partial interest in real property, and the IRS treats it as a taxable gift. When the value of that transferred interest exceeds the annual gift tax exclusion, $18,000 per recipient for 2026, you are required to file IRS Form 709, the United States Gift and Generation Skipping Transfer Tax Return for the year in which the transfer occurred. Most people who added a family member to their deed never filed this form because nobody told them it was required. The IRS's automated systems are now identifying these unreported transfers by cross-referencing county deed records against Form 709 filing histories. When a deed change appears and no corresponding gift return was filed, the system flags it. Beyond the reporting violation itself, the decision to gift property during your lifetime rather than passing it through your estate at death creates a second financial consequence that can reach into the tens of thousands of dollars for the recipient. Property received as a gift during the owner's lifetime carries the original owner's cost basis, what is called a carryover basis. Property inherited at death receives a stepped-up basis equal to the fair market value at the date of death. If you bought your home for $80,000 and it is now worth $400,000, your child inheriting it at your death would receive a stepped-up basis of $400,000 and could sell it with little or no capital gains tax. But if you gifted them a 50% interest while you were alive, their basis on that half is only $40,000, and the capital gains tax bill they face when they eventually sell could easily exceed $50,000 on that portion alone. Good intentions, incomplete information, and a consequence measured in tens of thousands of dollars. That is the pattern that makes this situation so painful and so important to understand clearly before making the decision. Understanding the risk is only valuable if it leads to action, so let me give you the clearest possible path forward. The first thing you need to do is gather every document related to your home and its financial history going back to 2021. Your original purchase records, records of every significant improvement, any home equity loan or HELOC documentation, including what the funds were used for, any deed or title documents showing ownership changes, and if you have inherited any property, any estate documents, appraisals, or probate records associated with that inheritance. Then take those documents and lay them next to your last 3 filed tax returns. You are looking for the gaps I described: a home equity deduction that may not qualify, an inherited property sale without a documented basis, a deed transfer that should have been accompanied by a Form 709 that was never filed. You are not expected to resolve these issues yourself. You are identifying whether they exist so that a qualified professional can help you address them in the most protected way possible. That qualified professional needs to be a certified public accountant or an enrolled agent with specific experience in real estate taxation and IRS penalty abatement procedures. When you contact them, ask directly whether they have experience with voluntary disclosure and amended return filings for real estate-related compliance issues. Those specific procedures exist precisely for situations like the ones I have described, and they allow people who come forward proactively to reduce or eliminate the accuracy penalties that would otherwise apply. The window to use those procedures voluntarily is open right now, but it closes the moment the IRS's automated system generates a formal notice with your name on it. After that, the options narrow and the costs increase significantly. The time to act is before the notice arrives. The information you now have is the foundation for taking exactly the right action: informed, specific, and taken while the most protective options are still fully available to you.